Hey guys, hope you are all coping well on this red bearish day. I personally have been absolutely jacked to the max on a video that was shared with me from an ex-hedge fund manager who confesses market makers do indeed use deep in the money call and put options in order to create synthetic shares. For months we have theorized that this was indeed how market makers introduce naked shares into the market, and today we are got full confirmation coming from the mouth of the horse himself. Yesterday we saw Citadel tweet for the first time in months, trying to do PR damage, denying accusations that they were pressuring Robinhood to restrict trading earlier this year. Robinhood joined Citadel in an emailed statement today as well. We are going to cover these two things plus a couple other minor things today. Believe it or not, there was a lot of very important things that have taken place during the last 24 hours, and we are going to break each and every single one of them here right now. I have come up with a bit of a theory that I think will add plenty of wrinkles, so buckle up. This is a major DD video, so do not sleep on it and pay attention. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. Let's get started. Let's begin with the banger of the day. In fact, I am just going to let the man speak for himself. The following video conference may produce intense arousal, so proceed at your own discretion.
But your deposition in that lawsuit is very damning of Goldman, including its use of options conversions to create fake shares to trade or lend out. And I read that Goldman tried to seal your court transcript. How did you find out about the options conversions, and how did they work?
What goes on, what you say with your fine, basically I'll simply say crime pays. So whoever is out there watching this, or whoever listens to what I have to say, listen to this carefully. Your brokerage firm does not give a rat's fucking ass about you. Robinhood could care less about you. None of these brokerage firms could care about you. They've all paid significant fines. Citadel's paid huge fines. Robinhood's paid fines. All these guys have paid fines. And it's basically like paying a speeding ticket. They just don't care. They don't care. They don't make changes. They don't give a rat's ass about you. So when we did this deposition, if you will, I couldn't stand Goldman. I couldn't stand Overstock. My lawyer, Shapiro, who was with me at the deposition, told the Goldman lawyer, do not ask Mark about Goldman and what Goldman did with the firm. Stay away from that, because that is red meat in front of a jaguar. And sure enough, the lawyer did, and I just lit into him. And I went over exactly how Goldman does business. And you know, these conversions, if you will, are or should be illegal, but there's a little loophole in this that I'll get into later. And basically, if Goldman or market makers in stocks and in options can be short the stock without a borrow. They can short you stock without them borrowing it, and they sell calls. They sell deep in the money calls for a premium, and they buy deep in the money puts, and they then sell you the fake or created shares where there's no borrow. And you have the shares, and when the borrow gets pulled or bought in, they simply reverse that trade, let's say for June, and roll it to July. And then when the issue happens in July, they roll July into August. So they keep rolling this trade as long as the customer wants it without ever having to deliver the shares. Now, there's a loophole that says market makers do not need to borrow shares to keep, in quotes, air quote, a fair and orderly market. And this is where the so-called naked shorting or shorting without a borrow comes from. Citadel, if they're a market maker in this day and age, can be short all the pick the name you want. And they don't need a borrow, and they don't need to pay the borrow fees, because if asked, they're maintaining a fair and orderly market. So market makers can legally, and this is the irony of this whole thing, can legally be naked short a stock without a borrow, because that is the law and that is the rule.
There you have it, Ladies and gentlemen, through the work and deep diligence of Broca, we were able to notice that there is a lot of weird activity in deep in the money and out of the money options. The leading theory as to how naked shares were introduced into the market are precisely by executing these option trades, and this ex-hedge fund manager just confessed that indeed, this is exactly how market makers go about it. I laugh in the face of each and every single media outlet and naysayer who said we were talking out of our you-know-what, not having true credence or real source to found such beliefs. Well, once again, we have proven them all wrong. However, there is something super serious here that you might have not caught, so please pay attention to me very very closely, because this changes a lot of the assumptions I have based. Cohodes, the man you just heard speak, subtlety states that what would make a market maker really anxious is getting a margin call, but not from the DTCC as I thought. Instead, what they fear is getting it from the bankers. I have been giving this a lot of thought, and I think it makes absolute perfect sense. Think about it for 1 second, because we know that market makers keeping these synthetic share operations are not scared of the DTCC, as I have gone on the record saying many times before. Market makers can survive wave after wave of margin calls because they simply have a ton of money they can borrow at essentially zero rates. This is why I always make sure to cover the Fed, because they are giving way to market makers to have essentially infinite money to keep on printing by allowing them to borrow if needed. This means that the DTCC is unlikely to worry them with a potential margin call, for now. Instead, we need to shift our focus away from the DTCC and place it on the banks. Why are hedge funds scared of the banks? Well, looking back through history, we know that investment banks failing were what helped trigger the last recession. Investment banks like Lehman are blamed as being the spark to ignite that awful recession which we still haven't fully recovered from. Now, and I need you guys to put your tinfoil hats for a second. What if because the Fed is and will continue trying to save face by keeping all the players afloat for the time being, they indirectly cause margin calls? Let me explain. So we know, as we have said many times covering the statements of Jerome Powell and general economic developments, that the United States is intending on keeping this as they are in regards of low rates for the most part in order to not cause a massive default and a market crash. We also know that through several provisions, certain banks have become too big to fail. But what if this is actually preventing banks from placing or granting risky loans, like the margin call that they gave Citadel? What if through the Fed's willingness to do everything, they inadvertently cause banks to take risk, and this is what scares Citadel because they know the banks aren't playing game? I made a video a little while back talking about how banks were caught with the real bag doing swaps. Bank of America in particular got caught in a bad spot when they created synthetic swaps against GameStop when they still had a ton of debt that it seemed they would not be able to pay. When GameStop paid it all, this placed a ticking time bomb on Bank of America and everyone else who got caught. As such, this would quite literally force banks to be completely risk-averse, because they have a position that they cannot fully pay off, especially considering that the prices for GameStop are so high, and that paying it off would inevitably cause a squeeze. This makes absolute total perfect sense, and it places puzzle pieces together yet again. Now we know why market makers are not worried about the DTCC, how they can keep on kicking the can down even if they get margin called by them for the time being, because they can simply borrow money at no expense from the Fed. Now we know that who they are scared of is their partners, the banks who are too big to fail. As such, they are both in very bad positions and have a symbiotic relationship where the other cannot be allowed to fail, but the banks also have a bit of leverage on them because they have them by their neck in regards to margin calls. If someone falls, banks have made it so that market makers fall first and get liquidated first so that the brunt of their own fall is softened. Jesus Christ, I think I just busted on myself a bit. Let's move on to the outrageous tweets that Citadel posted yesterday, which were followed up today by their accomplice, Robinhood. Citadel Securities fired back last night, saying they did not ask Robinhood or any other firm to restrict or limit its trading activity on January 27th. They said Citadel was the only major market maker during this time that provided continuous liquidity every minute, and that they executed 7.4 billion shares on behalf of retail investors. They allege that Ken Griffin and Vlad Tenev never met or spoke, and reiterated that fact that Ken said Citadel never requested Robinhood to restrict trading. What an absolute amalgam of lies and deceit. We have proof executives were planning on having Vlad and Ken meet, that they were in conversations, and that there was a lot of pressure from Citadel for Robinhood to halt trading. Funny enough, it was shortly after these conversations took place that trading was halted. What a coincidence, but it is the fact that Citadel did say they executed 7.4 billion shares on behalf of retail investors that caught my eye. Yes, as a market maker, they have the ability to print naked shares in order to add liquidity to the market, but how did they exactly fill all these orders when all the pressure was from buying the shares? How were these orders filled, Kenny? Please tell me in the comments. You see, each tweet that they posted only raises more questions than it answers. Out of those 7.4 billion shares, how many were for GameStop? What an absolute fraudulent market this is. The fact that the SEC still hasn't reported on this is absolutely infuriating. This whole stunt was a full PR move by Citadel to try to appease people. I find the timing weird and interesting. We have said and discovered a lot about Kenny and his trading tactics and schemes, but this is the issue they took problem with? Something in here is not like the others and I still can't figure it out. The worst broker in the world, Robinhood, took to email a statement today saying that the lawsuit paints a false narrative of collusion, to which Citadel CEO Ken Griffin himself said, and I quote, "It must frustrate the conspiracy theorists to no end that Vlad and I have never texted, called or met each other. But I must say, kudos to Vlad and his team at Robinhood for their remarkable success story. Somebody please, get me a bucket to puke. Guys, I don't think I have to say this, but always keep in mind that during litigation, everyone will always pose themselves as saints and that they did what was right on behalf of themselves and others. Lying to build narratives in court is the recipe for success, so feel free to laugh at this. The evidence suggests they are lying, their excuses are unfounded and only produce more questions, and their palpable indifference tells me all I needed to know to further consolidate my stance on buying more GME and AMC. Let's move on, there's nothing else to gain from liars and scum. Treasury Secretary Janet Yellen told the House Speaker that Congress has under 3 weeks to address the looming debt if they intend on avoiding an economic catastrophe of unprecedented levels. She states, and I quote, "We now estimate that Treasury is likely to exhaust its extraordinary measures if Congress has not acted to raise or suspend the debt limit by October 18th. This comes after Senate Minority Leader Mitch McConnell blocked a motion that would address the debt limit. Time is running out, and though I am still leaning pretty confidently that a measure will be passed to once again raise the debt limit, I still am following this situation closely, because if they don't raise this, expect a complete economic default. At that point, you will get the squeeze, but the entire globe will probably be in a really bad spot. Really sad to see this is where we are in this day and age, but I will always protect myself by hedging against poor markets conditions by investing in meme stocks." Last set of news I wanted to talk about come from Senator Elizabeth Warren, who called Federal Chair Jerome Powell a dangerous man after opposing his nomination. This is not a political channel at all, since you guys already know I dislike all parties since they are all puppets of money at Wall Street, but I am curious as to what you guys personally think of Jerome Powell. Please do share your thoughts and opinions in the comments. Do you guys think he's dangerous and vicious, or do you guys think of him as more of the same as we have always seen? I personally dislike him a lot, especially after he lied last week, and then took a stance to not take any responsibility if the market crashed. I think he's worse than bad, but I am open to a different opinion, so please share them below. Let's talk about today. The Fed reported total reverse repo operations at being over $1.297 trillion today, the highest recorded number for submitted reverse repo operations in history. Dark pool trades for AMC accounted for 61% of the total volume today, while GameStop's dark pool trades accounted for 31% of the total volume today. According to Fidelity data, buy order flow for AMC was larger than the sell order flow, with GameStop also enjoying a larger amount of buy order flow than its sell order flow. Let's now talk about performance. AMC traded bearishly as anticipated earlier this week, losing over 5% today. As you can see, the pre-market continued the same trajectory AMC had in the after hours yesterday. It continued falling until the market opened, where it experienced a small surge to around $39 before getting slammed down below 37.40. AMC traded between 37.40 and 38 for the rest of the day until a couple minutes right before closing. It was dipped in a very serious short attack that broke the support, having the stock close at 36.99, well below the VWAP. As you can see, even on the after hours, AMC continued to fall. I warned you guys this was going to happen, so I hope you mad lads have been throwing cash on this dip. As for tomorrow, there is good chance we could continue falling down, though at this point we are way oversold. If we were to dip any further, we would have support at 36. If we break that, expect another support wall around 34.67. If we bounce up, we are going to retest that 37.79. If we build on top of it, we could test 39.25. If tomorrow is like today, then we will definitely test $30 very soon. GameStop traded bearishly as well, losing over 5%. As you can see, it experienced a bit of the same bullish run during the first minutes of an open market before falling down to most of the day. GameStop did experience a bit of a surge that brought it up from 180 to near 184. However, during the last couple of minutes of the open market, GameStop had a fall that brought it down to a closing price of 178.60, well below the VWAP. As for tomorrow, expect support around 177 and then 172 if we fall again. Resistance will be at 183. It is unlikely we will break it and build on top of it even if we bounce back, but if we did, next resistance around be at 192. I think this week we touch 170 at some point if tomorrow repeats how we traded today. And that is all I have today. Thank you all for watching. I hope this video added some serious wrinkles for you guys. We did good work today putting a ton of pieces together. Let me know if you guys liked the video, if you guys are finding them educations and insightful, and let me know if you grew a wrinkle. If you want to support this channel guys, I have a Patreon link in the description as well as some one-time donation likes for Cash App and PayPal. If you saw what YouTube pays this channel you would think I work at a shoe factory for Nike in China. The algorithm hates robots so anything you provide helps tremendously. Thank you again for being a part of this channel. I will continue striving for better content. Enjoy the rest of your day and to the moon.